Hello everybody, today we will talk about futures. Future contracts are derivative securities which may sound overly complicated and scary. Indeed, you are not alone if you believe that futures and other derivatives increase volatility in financial markets and are responsible for financial instability in markets or larger economy. Derivatives has been blamed for a financial collapse of 2008, but do they deserve the harsh judgment? Probably not. Instead, we need to understand them, how they traded, their pros and cons, and how these instruments differ from each other. Derivatives come in all shapes and sizes, some of which are more nebulous and complex than others. Here we will look at future contracts, which give the holder the ability to take delivery in the future of some asset, pay for it a price today. These contracts are exchange traded and highly regulated, making them among the most innocuous and widely used derivatives contracts. Futures are contracts that derive a value from an underlying asset such as a traditional stock, a bond, or a stock index. Futures are standardized contracts traded on a centralized exchange. They're an agreement between two parties to buy or sell something at the future date for a certain price, called the future price of the underlying asset. The party who agrees to buy is said to be long, and the party agreeing to sell is short. The parties are matched for quantity and price. The parties entering a future contract don't need to exchange a physical asset, but only a differences in the future price of an asset price at maturity. Both parties need to pay initial margin amount, a fraction of the total exposure, with the exchange. The contracts are marked to market. That is the difference between the base price and the settlement price are dedicated from or added to the account of the respective parties. The next day, the settlement price is used as a base price. The parties need to post additional funds into their accounts if the new base price falls below a maintenance margin. The investor can close out the position at any time before maturity, but has to be responsible for any profit or loss made from the position. Futures are an important vehicle to hedge or manage different kinds of risk. Companies engaged in foreign trade use futures to manage foreign exchange risk, interest rate risk, if they have an investment to make, and lock in the interest rate in anticipation of a drop rates, and price risk to lock in prices of commodities such as oil, crudes, and metals that serve as inputs. Another important role futures play in financial markets is that price discovery. Future market prices rely on a condition flow information and transparency. A lot of factors impact the supply and demand of an asset and thus its future and spot prices. This kind of information is absorbed and reflected in future prices quickly. Future prices for contracts nearing maturity converts to the spot price, and thus the future price of such contracts serve as a proxy for the price of the underlying asset. Future prices also indicate market expectations. For example, in case of an oil exploration disaster, the supply of crude oil is likely to fall, so near-term prices will rise. Future contracts will later maturities may remain at price crisis levels. However, because of supply is expected to normalize eventually. Contrary to general belief, Future contracts are enhanced liquidity and information and dissemination, leading to higher trading volumes and lower volatility. Futures are a great vehicle for hedging and managing risk. If someone is already exposed to or earns profit throughout speculation, it's primarily due to their desire to hedge risk. Future contracts, because of the way they are structured and traded, have many inherent advantages over trading stocks. To trade futures, an investor has to put in a margin, a fraction of the total amount, typically 10% of the contract value. The margin is essentially a collateral that the investor has to keep with their broker or exchange in case the market moves opposite to the position he has taken and he incurs losses. This may be more than the margin account, in which case the investor has to pay more to bring the margin to a maintenance level. What trading futures essentially means for an investor is that he can expose himself to a much greater value of stock than he could when buying the original stock, and thus his profit also multiply if the market moves in his direction, two times if margin requirement is 10%. Let's take an example. For example, we would like to purchase 10 stocks, Apple stocks, with the price of $125 for one share. We can either buy 10 stock or a future contract holding 100 Apple stock, 10% margin for 100 stocks, supposed to be $125. Now, assuming a $10 increase in price of Apple, if the investor would have invested in this stock, he would earn a profit of $10. Whereas if he took a position in an Apple future contract, his profit would be $100. Thus, his profit also multiply if the market moves in his direction. So 10 times if margin requirement is 10%. Future markets are very liquid. Future contracts are traded in huge numbers every day, and hence futures are very liquid. The constant presence of buyers and sellers in the future markets ensures market orders can be placed quickly. Also, this entails that the prices don't fluctuate drastically, especially for contracts that are near maturity. Thus, a large position may also be cleared out quite easy without any adverse impact on price. In addition to being liquid, many future markets trade beyond traditional market hours. Extended trading in stock index futures often runs overnight, with some future markets trading 24 hours and 7 days per week. Commissions and execution costs are low. Commission on future trades are very low and are charged when the position is closed. The total brokerage of commission is usually as low as 0.5% of the contract value. However, it depends on the level of service provided by the broker. An online trading commission may be as low as $5 per site, whereas full service broker may charge $50 per trade. Speculators can make faster money. An investor with a good judgment can make quick money in futures because essentially he is trading with 10 times as much exposure than with the normal stocks. Also, prices in the future markets tend to move faster than the cash of spot markets. The word of caution, however, just as wins can come quicker, futures also magnify the risk of losing money. However, it could be minimalized by using stop loss orders because the futures are highly leveraged. Margin calls might come sooner for traders with the wrong way bets, making them potentially a move risky instruments that a stock when the market move fast. Futures are great for diversification or hedging. Futures are very important ventures for hedging or managing different kinds of risk. Companies engaged in foreign trade use futures to manage foreign exchange risk, interest rate risk by locking in an interest rate in anticipation of a drop in rates if they have sizable investment to make, and price risk to lock in price of commodities such as oil, crudes, and metals that serve as an inputs. Futures and derivatives help increase the efficiency of the underlying market because they lower unforeseen cost of purchasing an asset outright. For example, it is much cheaper and more efficient to go long in S&P 500 futures than to replicate the index by purchasing average stock. Future markets are more efficient and fair. It's difficult to trade on inside information in future markets. For example, who can predict for certain the next Federal Reserve policy action or the weather for that matter? Unlike single stock that have indicators or corporate managers who can leak information to friends or family to front run a member of bankruptcy, future markets tend to trade market aggregates that don't lend themselves to insider trading. As a result, future markets can be more efficient and give average investor a fairer shake. Pay attention that future contracts are basically only paper investor. The actual stock commodities being traded is rarely exchanged or delivered except on the occasion when someone trades to hedge against a price rise and takes delivery of the commodity stocks on expiration. Futures are usually a paper transaction for investors interested solely in speculative profit. This means futures are less cumbersome than holding shares of individual stocks, which need to be kept tracked of and stored someplace. Companies need to know who owns their shares in order to pay out dividends and to record shareholder votes. Future contracts don't need any of that record keeping. And short selling also easier. One can get short exposure on a stock by selling a future contracts, and it's completely legal and applies to all kinds of future contracts. On the contrary, one cannot always short sell all stocks. And there are different regulations in different markets, some prohibiting short selling of a stock altogether. Short selling stock require a margin account with the broker, and in order to sell short, you must borrow shares from your broker in order to sell what you don't already own. If a stock is hard to borrow, it can be expensive or even impossible to short sell those shares. Futures have great advantages that make them appealing for all kinds of investors, speculative or not. Futures are a great venture for hedging and managing risk. They enhance liquidity and price discovery. However, they are complicated and one should understand them before taking on any trades. The goal of regulating standardized derivatives could have the negative side effect of drying up liquidity to fix something that is not necessarily broken. Thus, one should strategy and do due diligence before trading futures and understand both their advantages as well as their risk. Thank you so much for your attention. For today, that is all. Stay safe. See you soon.